Hi, Jason Moss here, and I am here to talk about whether the market is going to crash in 2021 or 2022. So let's get going. This is time sensitive. I was going to do some other fun videos, but I realized I need to get this one out of the way first. I learned this lesson one time that when there's massive market changes, fortunes are made and lost. That's when the best opportunities are, when there's massive market changes. And so we're going to talk about those. We're going to talk about how to capitalize on them. So if you want to make a fortune and not lose one in the next market shift, and there are several coming, you need to watch this video. If you can stay with me till the end, I promise you there's something in here that's going to help you make money from the next market shift. But more importantly, I wanted to show you how I read the indicators of supply and demand and other factors that affect the market so you can know when to buy and when to sell. If you don't want to hear this portion with my predictions, I'll put a timestamp here and you can just skip forward to how you can make money from the shifting market. So I have to tell a 60-second background to set the stage. The year was 2004. Interest rate on savings account were 5.5%. Home prices were going up by $10,000 to $20,000 a month. Everyone is making money in real estate. All my colleagues were leveraging their properties as much as they could, sucking out that money, finding money in mattresses wherever they could get it, and buying real estate because it was making so much money. If you walk down my street, 5 out of 6 homes were vacant. Rents were about 0.2% of the purchase price and heading lower because everyone had houses for sale and nobody was really renting. Lots of people were buying and there just wasn't enough occupants for the amount of housing that was out there. Things were looking rosy. You could buy a house with basically a signature. Subprime and stated income was the norm. Mortgage fraud was rampant. And I saw all this because I was an appraiser at the time and I was into the market stats and I was watching these numbers go up month after month, $10,000 here, $20,000 here. I saw the inventory levels getting low and I realized this was not sustainable and it couldn't sustain these levels. But at the same time, it was a false demand because like I said, these homes were sitting vacant. It was based on speculation and the willing participating banks that were going along with it. Now, I decided to be safe and pay off my properties. I kept my mortgages no more than about 50% of what they were worth. So I'm no fool, I thought. I'm going to play this smart. So we all know what happened. 2004 was a massive year. 2005 was a massive year. But at the end of 2005, things started to slow. Days on market increased. And people thought, well, I'm just going to hold out, wait till the market comes back. I'm going to keep my price where it's at. Wait for the demand to get back, but the demand never came back. It was not until 10 years later until the values got back to those same levels. But people couldn't wait 10 years to get their house values back because they had bought these properties on fake income. They couldn't afford the mortgages and they couldn't rent them out for what they were worth. Now, obviously, this is different in every market, but in the development areas, this is what was happening. And then to compound that, all the adjustable rates from the previous 5 years started expiring, pushing hundreds of thousands of homeowners into mortgage payments that they could no longer afford as interest rates were rising, forcing them to sell and increasing the supply of homes and pushing down the values with every home that was listed. And every home that foreclosed also contributed to more supply and values going down. It was chaos in the streets. Fortunes were lost all over the world. Few fortunes were made. Obviously, in hindsight, I would have been in a different position and I would have been in a position to capitalize on that changing market. But I just was too green and didn't understand what was happening. And I don't think anyone did quite to the level that it did happen. So fortunes were lost, including my own. No one expected the severity of the market correction that came. One by one, I slashed my property's values as I saw the prices going down. But because I had a lot of equity, 50% in all my houses, I was able to drop the price considerably and sell most of my properties. I did get stuck with two properties that I was emotionally invested in that I didn't want to sell. And that's never a good idea when you're involved in real estate. You always want to keep emotion out of it. But in this instance, I did end up foreclosing on a couple houses because I was emotionally tied to them. Okay, now that I've set the stage, look at this chart. This is breaking news. This has just come out the last quarter of 2020, and we're looking around the corner right now to 2021, hoping to put 2020 in our rearview mirror. But these numbers are very exciting. So this is for Arizona. However, this is similar in a lot of markets across the country. Not many markets in California and not New York. They're losing demand for a variety of reasons, but a lot of the rest of the country has an oversupply of demand. So you're going to want to check your numbers in your own market. You're going to want to check migration patterns. Some areas of the country did not go up a ton in the last boom, and therefore they didn't fall in the last crash. So there are markets that are more static, and there are other markets that are more volatile. In those more volatile markets, you can really make a lot of money. And in those static markets, you can also make money. It's just a different strategy. So this chart is a market indicator. It's the Cromford Market Index as a predictor of future annual price appreciation. So you've got the line on top, that's the prediction. The underlying marks are the actual numbers. So as you can see, it's been historically pretty accurate. Now, they didn't have this chart that I knew of. I mean, I was watching the Cromford report back then, and I don't remember ever seeing this report. So it's easy to say in hindsight what this may have done. But historically, this has been pretty accurate. And so looking at it, you can see in the last quarter here, the demand supply ratio has pushed it to a point to really drive this number up to levels that we haven't seen since 2004. Now looking at this next chart, and I don't want to lose you here with all these charts. Stay with me here. I'm going to get through these pretty quick. But you can see in 2004, there was quite a big gap between supply on the bottom and demand on the top. And then in 2007, when the markets were crashing, you saw the inverse of that. You saw high supply and low demand. Then now looking fast forward to today, the end of 2020, beginning of 2021, our demand is super high and our supply is historically low. So that creates an awesome opportunity in these areas that have similar metrics to this that says buy. I'm going to buy everything I can get. Annual appreciation is predicted to go up quite a bit over the next year. However, at the moment, there are no signs of this going down, but as a general rule, this video will come and go, but the principles are the same. You look at supply, you look at demand, you look at interest rates, you look at inflation, you look at migration patterns. And with those things, this is way easier to predict than the stock market. So currently, there are no signs of this correcting like it did in 2005. According to the indicators, as long as supply remains low and demand remains high, we should see some nice appreciation this next year. This will not always be the case, though. Market changes. But the point is, when there's a supply lack and a demand surplus, it's a good time to buy. When there's a demand lack and a supply surplus, that's the time to, well, hopefully you had a strategy in place before that. And that's what I'm hoping to do here with this video. So my goal here was that within a few minutes, you can look at the supply, you can look at the demand, you can look at migration patterns, you can look at interest rates and inflation and determine, is it a good time to buy or is it a good time to sell? Oh, also you want to look at building permit numbers versus the migration, how many people moved into the area. So this is way easier to predict than the stock market, in my opinion, and oftentimes you can see the signs coming from miles away. So to give you an example, in the Phoenix area, the greater Phoenix area, we had 40,000 building permits and we had 90,000 families moving into the area. So you can see there's not enough houses being built for the amount of people that are moving here. And that's been that way for the past 12 years. Okay, now you can say that the real estate market is strong, but the real estate market is made up of several markets. There's a national real estate market, there's state and local, there's county real estate markets, there's markets within the county and cities, there's the commercial market, there's the single family, there's the multifamily market. So when you're talking about markets, you got to be specific. And one thing I need to talk about before this video is done is the pending commercial retail office building crash that I think is coming. So what you've seen up until now is a pretty healthy office market for office buildings, but because of COVID in early 2020, everyone was forced to stay home. Companies had to innovate. They had to figure out how they can have their officers and employees work from home. And so there was a lot of Zoom meetings, a lot of innovation going on to make this happen. And I think what's happened is that's kind of leapfrogged us years, probably maybe even a decade or 5 years down the road technologically, with a lot of these companies that would probably never have made this leap for a while. But now they were forced to work from home and have their employees work from home. And now they're starting to realize that they don't need these big office buildings. They don't need all these leases. They can, when people work from home, the productivity is a little bit less. However, how much money are you going to save on those leases? I've talked to a couple companies. One is a bank. They said they'll never sign a commercial lease again because they've realized that they can do all this from home. As a mortgage banker, they've realized they don't need it. So they're going to save all this money and they're not going to renew their lease when it comes due. And I'm sure that's going on all across the country. As these leases for these commercial office spaces come due for renewal, they're just not going to renew. Or they're going to downsize into a much smaller space. So if you have office space, in my opinion, I would get rid of that as fast as I could. And this is already starting to happen in a lot of areas. I know New York's having severe trouble with this, but it's not going to be localized to New York. Maybe people will get creative and start to figure out how to use these spaces as additional or alternate uses. But in the meantime, this is a big deal because there is again, it goes back to supply and demand. Right now, there was a balance in supply and demand, but now because of COVID and technology, there's not that demand anymore. That demand's going to evaporate over the next year or two. So if that does happen, how are you going to profit from it? Well, probably just like the crash in 2008, you're going to want to have some assets to be able to scoop up some of these office buildings when they're pennies on the dollar and cost less than what they cost to build. So that's how I would make money on these. If you know of anybody that has an office building, it may be prudent to share this video with them. So you got to be really careful if you're in that space. You got to watch your submarkets and really look at your numbers and make sure you don't get caught in some of these commercial office buildings. In my opinion, they're going to be really hurting in the near future. Maybe we'll turn them all into Amazon warehouses or something like that. We'll see what happens. Okay, so this is my last chart. I'm going to go through this really fast. But what I like about this chart is it shows the average appreciation over a 20-year span. Let's pretend the bubble didn't exist and the market just kind of went up at that 4.5% inflation appreciation rate at a pretty steady level. We'd be a little bit just about where we would be if that bubble hadn't happened and collapsed. That market kind of that trajectory. So we went up, we went down, and now kind of we're back to, and everyone's saying, oh, we're back to 2005 levels, and that's why people are getting nervous. And I don't know that that's necessarily a reason to get nervous. You look at the underlying metrics, but the most important thing, you look at the last 10 years average is obviously 9.3, but you don't want to use that either because that is based on the extreme factors that came from the crash, and there's a lack of a lack of supply and super cheap housing, and so that appreciation naturally just rose back up. It's like if you jump in a lake with a life jacket on, you're going to sink for a second, you're going to pop right back up. Okay, the question is, how high do you pop up above that water before you come back down? And that's the question we're trying to figure out here. So if you look at this chart, the one thing that they're not factoring in to any of this is inflation. So as the markets were crashing back in 2005 through 2010, the government jumped in and pumped trillions and trillions of dollars into the market. I mean, the thought behind it was to stimulate the economy, and it did just that. But in the end, that took the amount of money that was in the economy and grew it to massive amounts that we haven't seen in history. I think I'll put the stats up here, but in 2000, our national debt was around 5 trillion, and I believe now we are at 20 trillion. Just over that time period, and then 15 trillion of that was since 2005. So a massive amount of money has been pumped into the market, and what people don't think that that's going to have an effect on prices. When the amount of dollars in the economy grows, inflation is right around the corner. And what the government is telling us is the inflation is right now around 2 to 3%, but most people know that that's a joke, and the true inflation numbers are quite different. Now, historically, over the past 30 years, inflation has been 2, 3, 4%. The government reports it as one thing because in their definition of inflation changes over the decades to kind of suit their needs. The reason being is because Social Security and other government programs are tied to inflation. So if they were to report the true number on inflation, they would have to increase the government spending to pay for those services, and it's just this big cycle, and you get into a situation like the Weimar Republic or Venezuela more recently, where there's hyperinflation. You're just basically printing money to pay out money to print more money to pay out money. It's this big cycle. But if you do some quick research on the internet, you'll find that third parties have tried to figure out what the true inflation number is, and there's like the burrito index. There's basically how do you feel it in your pocketbook. The inflation is based off the consumer price index, but in reality, what has the price of milk done over the last 20 years? What has the price of a car done over the last 20 years? Colleges, things like that. Now, technology is different because it goes down in value because of processes and things get faster and cheaper and easier. So you kind of take technology out of it, but living costs tend to go up. And they estimate, these third-party companies that try to figure out what the true number on inflation is, estimate anywhere from about, I've done a ton of research on this and found that most companies think it's around 6 to 13%. So just taking that right in the middle of the road is a 9%. So what that means is if you have $100,000 in the bank and inflation is 9% that year, that means that $100,000 only buys about $91,000 worth of actual goods and services. It feels like it's still $100,000. It didn't change, but it only buys about $91,000 worth of stuff. Cars went up by 10%. The cost of getting a bicycle for your kid went up 10%. And it's incremental and you don't really notice it, but you kind of feel it in your pocketbook. And that's what people realize. They realize that year over year, it's harder and harder to make ends meet, and they're not sure why. And inflation is really a big market shift that's coming down the pipeline that nobody's talking about, and is not that nobody's talking about it, but most people don't really realize how it's going to affect things. So when you look at things like this chart that show annual appreciation up till 2005, then we had a bubble spike because of various factors, but that was abnormal. Getting back to a normal appreciating market that kind of follows along with inflation, what has happened now is inflation has gone from 2 to 3% to now 9%. So the cost of homes, the cost of lumber, everyone's seen this over the last year or so. The cost of lumber has been going through the roof. The cost of all kinds of building materials is going up. So you don't think that's going to have an effect on housing prices? Just because the housing prices today are similar to what they were in 2005 doesn't mean they're high. It means that the costs to build these houses are higher, and they're probably never going to go back. So I think at some point in the future, we'll have wages increase, but I'm not sure how that's going to play out. Okay, so to sum up, why am I talking about all this inflation? It's because if you look back at this and I look at the charts, and after doing all this research, I really feel that we are in a position to have a very strong 2021 in regards to appreciation, with the exception of the commercial office building space. I think that's going to be going down, but I don't know if it'll be this year or next year as these leases expire. So yeah, I think the market is extremely strong. There's a lot of opportunities to make some money here. And I'm going to end the video right here, but I'm going to pick this up on my next video talking about inflation and how to profit from all these different changes coming down the market, because I think there are several different changes that are coming. And in the next video, I'll talk about each one and how to profit from those. So like and subscribe, and really I'd love to hear your comments down below on what your thoughts, what your predictions are, if you think I'm right, if you think I'm wrong. Let's get a discussion going. All right, we'll see you next time.